So we're talking about China's unique problems. Now, it's just not that, as I've said, and you can go back to the videos in China on this that I've done in this series. There's a lot of background information. But we're just recapping on this, basically, as I said, the summary video side of things. Now, China's got unique problems. It's not that it's just the 40 trillion that it's accumulated in debt in the last 10 years. It's because it has accumulated 40 trillion in 10 years. And that's a phenomenal exponential growth in debt. And it's not. It's been a combination of government debt through the funding of SOEs. It's corporate debt, household debt, and it's all exponentially grown. And historically, debt binges don't end well. And I don't think China is going to be any more immune to the debt bubble bursting than anything else. It's just a question, really, of how China gets nobbled, basically, when as I say, I think Europe comes down first. So, credit you see, the thing you got to look at in China, the credit cycles are already negative, as I pointed to in the video. What we've seen corporate defaults start to grow exponentially from the February-March of 2018 up to the last default back in December, and another few back in January this year. Now, the other thing is demand is slowing because with the trade war with the United States, what we've seen is we've seen that exports have been front loaded because obviously there's more profit before the tariffs come in, because people generally, if they're in business, don't want higher costs, so it's better to have their goods already in and stored than there is. So this has had a twofold effect. It's meant that the current account deficit with China and the United States has grown, but also the export income that China received has had a boost. So this is going to start showing signs of slowing off as this front loading has occurred. And there's been a recent paper to clients, Credit Suisse has suggested that a substantial property price fall could cause a hard landing. You see, property accounts for pretty well 40 to 50% of loan collateral with the banks in China, and this constitutes 50% of household wealth. So there's a lot at risk if the property market collapses on itself. And the current property turnover is reminiscent of just a small fall in price. So even though there have been falls of 10%, 15% in Tier 1 cities, it hasn't been enough to trigger a full-scale sell-off. It's what happens when there is a full-scale sell-off that the problem begins in terms of the collateral in the Chinese banks, especially in the shadow banking sector. So this is the thing. If there is a massive sell-off of properties in China, who's going to buy it? Because 80% of Chinese are property owners. So are they going to be, with properties falling, are they going to buy any more property? No, they're not. Because the banks aren't going to be able to lend any money on it anyway, because they won't, because the property values are falling. And those people that have 30% of Chinese households own more than one house. So they're going to try and offload because they're not renting those properties out. So that's a matter of concern. Now, the other side of things that people have overlooked as well is that Chinese credit card debt is now at 7%, where it was non-existent, 7% of GDP. It was non-existent 10 years ago. 7% of GDP, 12 trillion, 7% of that, well, you work it out, it's close to 1.5, 2 trillion of dollars. So we're now starting to see more expensive financing going ahead in China. Now, as I said, it's the massive debt accumulation in China that is the problem. This goes back to the beginning of the video where we talked about debt overhang. That is what will happen with the domino effect with contagion. It's the ability to pay back this debt, because in a free fall, in the wiping out of assets, asset classes, whether property, shares, bonds, etc., like that, nobody's a buyer. There's no bid. There's no bid for bonds. There's no property side of things. Banks don't want to lend So basically you do have a major problem in that. Now, the problem for the Chinese economy is that whereas it could reflate, in technical terms it did, it reflated the economy, the world economy back in 2008 with a massive stimulus that the Chinese government had. You see, consumer spending is not going to take the Chinese economy out of the doldrums if this happens, because there's only 40% of their economy in consumer spending. So one of the major areas where China has benefited is the export revenue and the debt, obviously, that the government has been printing. Well, the export revenue, as a major pillar of the Chinese economy, is going to start shrinking, and already they've got shrinking GDP. So this is a potential weakness, and this is going to be felt more in the shadow banking sector, because, you see, at the end of the day, the Chinese government, as far as its own debt's concerned with the state-owned enterprises, can just basically write a pen and say, right, debt's gone. But the problem will still persist in the private banking sector and in the hidden and opaque sectors and the opaque debts which I covered in the video on this series on China. So, you know, it's the amount of liabilities that the Chinese government may be forced to try and come to terms with is not really quantifiably known at the moment, and that's the risk going forward. So the people say that China's got a high rate of savings, and yes, it has, but these savings are in Chinese banks. Yes, to a large extent, that many of them will be safe, but what if you lose 30% of your income in the banks? What if you lose 30% of your income from property crash? All of a sudden things don't look so rosy. Then there starts to be political instability going forward, and this is something that the Chinese government does not want. Because let's look at it at this. Let's look at it this. Last month, the Chinese injected 5% of the value of their GDP to keep the economy going. So what's 5% of 12 trillion? It's close to 600 billion. They put 600 billion in 1 month into their economy, and we're talking about 60 billion a month that the Fed put in and the European Central Bank put in, and they put in 600 billion. A strong economy, or an economy that's not weakening significantly, doesn't do this. So there are alarm bells that are actually going on there. So this is a major issue with China, I see, because things are not as rosy as one would like to say. The facts are, as I say, you put a lot of money in like that in 1 month, there must be something going on behind the scenes. And I wouldn't be surprised if later on down the year we see something happening in terms of more and larger corporate defaults. So I don't want to go into so much more on the China side of things. Let's go and look back and a little bit about how these guys, all these three regions interact. Now, the global economy is burdened with the debt. It's a massive debt thing. I opened the video with 400 trillion, but alone in the United States, we've probably got close to 400 trillion. So goodness knows what the global debt problem really is with the Europe, you know, the United States and with China, all the hidden debt there. So even though the United States has accounted for most of the debt, the current strength of the economy is based on a massive debt spurge. We have accumulated $2 trillion this year in 2018, this past year in 2018. So we're not in a war situation, we're not in a crisis situation, we're not even in a recession, and yet we've put $2 trillion on 10% of the US balance sheet in 1 year. What's it going to be like if we hit a recession, a major recession? This is unquantifiable in that respect. So, and the other side of things is that we're now starting to see, as more debt comes on, the actual utility of that debt to be able to provide GDP growth, whether it's in Europe, United States or China, is decreasing rapidly. So when we go into recession, and if we go into a full-blown crash, the chances are that the Fed and the central banks and the People's Bank of China aren't going to be able to pull a rabbit out of the hat in this one. So I think there's great structural problems, and the risk of contagion is just so incredible that it's not funny. So because the rates are so low at the moment, it hasn't become a problem, but it will become a problem. At some stage, there is a point where you have to pay back what you've borrowed. It could be 5 years down the line, it could be a year down the line, but it's more likely that the problem is not necessarily going to be initially caused by a government, a national government, defaulting on its bond issue or something like that. It's more likely to be a credit event like Lehman Brothers. Now, the USA really is a debt monster. I mean, there are so many areas of concern, present and future. I mean, we have the national debt, we have auto loans. The auto loans are like liar loans of the back in 2008. We've got the student debt. There's so many outlying factors, the junk bond status and the corporate factor. I mean, there's the potential of a financial institution going up in smoke in the United States. But it seems to be less likely that happening than in Europe. So whereas it's, as I say, the USA is a debt monster at the moment because of the way the economy looks, it's less fragile looking than Europe. So, and when all this debt's been accumulated and all these rates are so low, we've got to ask ourselves, when there was a 0.75% hike in the interest rates and we had a hissy fit from the US markets and stocks plunged and things like that, we were talking about 0.75% increase. It's nothing. So basically, any sizable shock to the system is going to have tremendous effects. So what's going forward in this? Potentially European bank failure, European corporate failure, Chinese property plunge. Either way, everything is so linked, but it's much more linked between the United States and Europe. And what I feel is what's going to happen is that when the crisis happens in Europe, potentially Italian bank crisis, potentially even more potential political crisis in France, as we've seen with what's going on there, Europe is pulling itself apart. They're trying to put a brave face on it, and if somebody bails out of the the euro, that's it. It's game over, basically. As I've said before, on the European side of things, if Italy's forced out of the eurozone, that's the whole thing that could bring down the whole house of cards. So the greatest, when we look at this, we're talking about, you know, it looks like it's a terrible situation, and it is a terrible situation. You've got to be prepared. So what's happening with contagion is that one thing you've got to remember is that the greatest acquisition of wealth always occurs for those people that are in a position to take advantage of it. So you've got to find strategies where you are taking a more defensive role in this side of things, but not sacrificing what's occurring in the medium to short term, because we're talking about some stage in the future, and I can't predict when, because it's effectively when the credit splurge stops and it runs out of steam, and then something breaks in the system, an event. So we tend to look at strategy and what's going on in the macroeconomic level, and therefore we strategize. Our base is what's happening in the macroeconomic level. But having said that, there are medium terms and short term horizons to take advantage of profitable opportunities in the market, and you'd be mad not to do that. But the fundamental base is be prepared for, you know, a major crisis, and it's going to come, and you don't want to be caught out in it. Now, there's a higher. You're saying, well, gosh, I'm really negative. No, I'm not. I'm just careful. I mean, if we're talking about clients' money, and at the end of the day, you look at when a market collapses, it goes down in a vertical spike. That's when most people panic. They're rubbing their hands. Oh, it's nice profit made at 1% a day, 2% a day. Well, when the market collapses, you lose 20, 30% of your portfolio sometimes, and it takes a while to recover. Maybe this crash will take a much longer time to recover. So by keeping an eye on the macroeconomic situation and looking at the hard facts as they present themselves, you could interpret these and say these facts are all wrong, but I would hate to be in a position to say I told you so, because it's too late then. So when we look at these situations, this is when we take into consideration the bottom line, what's actually going to happen, and then work back from that. So you should do the same. You should actually, well, what's the worst case scenario? How can I protect myself from these potential events? And then move forward on that basis, but not be so gloomy as to say, oh, there's nothing I can do. There's always something you can do, but you have to be aware of being able to keep liquid. The important thing is to keep liquid. So I look forward to seeing you in the next video when we're going to deal more with, say for example, current political crises in Europe and their economic effects. Thank you so much for watching this series of videos, and I'll see you in the next one. Thank you and bye.